Now we'll look at negative MACD divergence. A negative MACD divergence occurs when we see price moving in an uptrend or a price making higher highs and higher lows, while MACD has turned down. It has stopped making higher highs and higher lows and has since turned down and is making lower highs and lower lows, potentially leading price as price may turn down in the direction of MACD. So the downturn in MACD may anticipate a down move in price. Having a look here at one of our older slides where we include the 12 and 26 and the 9 on the chart, but again, I do not advise that you place these indicators on your chart because they're effectively useless because by the time they cross over, it is well too late to get in the move. We see a nice uptrend here, an aggressive uptrend, and a parabolic spike, and often you'll get a second attempt. Here we see a second attempt up. This was effectively generated by an economic report that came out, and price moves up slightly beyond the previous high, while MACD had already started to move lower and forms a lower peak, while price attempted to make a new high, was rejected, while MACD is making a lower high preceding price, and a nice down move follows. Here on the 60-minute chart, we see price moving up, forms a new high, holds above the previous high, parabolic spike, and they move down. While MACD had been already neutralizing and moving down, forms a very modest or very weak high and precedes price down. Again, looking at a daily chart, and I really like this chart in that we see a very nice steady uptrend. Price forms a high. We have a retracement. You see these previous highs here. Resistance becomes support. Price rallies, and in one day it makes a move higher. MACD is diverging, forms a peak here. The following day, price moves lower, forming a couple things. Here's a railroad tracks, but you see our price closed below this high here. So we see a price close below that high, close below these highs, MACD divergence. Typically here we can anticipate a down move from this point. Sometimes we may get another attempt here, forming the right shoulder of a head and shoulders, but in this case it just continues down after this doji formed the following day to digest this move. Price forming a steady trend, the market making aggressively higher highs and higher lows, a nice retracement, a rally. While price rallies, MACD responds, but the trend has been overbought here. Price responds, MACD making a lower high, while price makes a higher high, and then breaks down. Now this trade could be made when you see these lows right here. If you draw a line across these lows and price breaks below those lows, as well we would see a trend line break that converges with these lows. When price starts to move below those lows, and you see here how this wick spiked up. At one time it was a bullish candle, testing the low of these lows, and then move down. More negative divergence, price moving up in an aggressive move up while MACD is drifting down. We see a head and shoulders formation, and we're going to get into this into a lot more detail later. Head and shoulders with MACD divergence, and then price moves down. A nice move here, and there's something interesting that I want to point out here. As you see, as we move down into these smaller time frames, the 15-minute, you see how price has formed a high here, an intraday high. It retraces nicely, forms another intraday high, but MACD is already diverging and could potentially lending to a trade at that point. But price moves up higher on one more occasion in the same day. MACD continues to move lower before a nice down move. A couple things I want to point out here is, number one, you see this high here. This resistance acts as support, and as well we have a low of 74.40, and price moved here all the way up to almost 76.40. So that was a reasonable it was reasonable to anticipate that price could move down from here, but it didn't. It took one more leg up. And the lesson here is that MACD divergence is not a holy grail, that price can continue in the same direction that it has been trending, even though we see price trending this way. What I like here is how this low came modestly lower than this low after this high was, before this high was formed. Just going to talk briefly about the MACD trigger line. MACD punching through the trigger line can be a confirmation of MACD divergence. I'm personally not inclined to take a new position based on a move through the trigger line. To me, it's just simply a kind of a longer term confirmation of a move that I would already like to be in, or I may already be in and out of. But a move through the trigger line is I would not jump into a trade after price has moved so far as to see a move through the trigger line. So price may have already moved considerably before MACD pushes through the trigger line. And if you have to chase the market here, then you may experience a pullback in price and get stopped out of your position before flows can move price further in your direction. So when do I make an MACD divergence trade? Well, it's the same that we've been saying. Is you don't want to trade MACD divergence on its own, because it is a lower probability trade to trade it standalone, and you should just have too much knowledge of the market and to know better than to trade an MACD or a trend line or other tools standalone, with the exception of very specific circumstances or exceptional circumstances. You want to combine your MACD divergence with other tools to discern good trading opportunities. MACD will complement your knowledge of candlesticks, pivots, trend lines, Fibonacci, and all of the other resources in your toolbox to help determine high probability trading opportunities. The idea is to look for a combination of factors that present high opportunity trading opportunities as presented through your charts. Let's just have a quick look at MACD divergence and candlestick formations. Here we see an MACD divergence on this low right here, while MACD is diverging up, but here we see a price to hold below this day's low and a real nice hammer. Price does come a little bit lower to test, but then the sellers, there's just far too much buying pressure as a result of this failure to move lower, and we see a nice up move by a couple of hundred pips, 74.40 to 76.40 and beyond. And then this is the MACD divergence that we discussed just earlier. Here we see a negative divergence, railroad tracks, and a hammer. Here, hammer, railroad tracks. This will also lend to another indicator that we're going to introduce later, and that is the max true range, the max true range indicator, which is one that I really like to trade. The character of a MACD divergence trade: we want to look for a divergence between price action and MACD. We want to look for reversal candle patterns. We want to potentially look for a head and shoulders pattern. We want to use pivots and or Fibonacci's to refine our entry. We want to look for trend line breaks to potentially confirm, or you may even be before the trend line break. So the trend line break is a confirmation of already being in a move. MACD crossover corresponding with the trend line break to further confirm your move. Some other factors which I would consider minor points, and that is an MACD cross of the 9 EMA and an MACD cross of the waterline, which I would consider to be minor, as well as separation of the 12 and 26 and the 9 EMA.